All right, so you've heard the commentary, I hope. What do you think happens to stocks now that Powell said what he did over the last couple of days?
Yeah, I mean, I like it. I would love to see 50. It doesn't look like 50 now with some of these firm inflation readings. I think we should have a Fed funds rate around 170. I'm really uncomfortable when the 10-year is so much below Fed funds. But certainly the direction is right. The momentum is there. I heard a mention of 17 times earnings. Actually, when I look at earnings, I put a conservative spin on it. I think fourth quarter earnings estimates on S&P are too high. I think we're really 19 now. But could we go to 2022? Yeah. But that puts you in a little kind of a precarious situation. I'd feel better if transportations were hitting highs. I'd feel better if Russell 2000, which is still 10% below last year's high. But nonetheless, I mean, little inflation is definitely good for the market. It might slow the Fed a little bit. But, yeah, I mean, the short-term trends and technicals look good to me.
I say overshoot possibility. What do you say?
I think possible. Yeah, I mean, listen, I mean, almost that's the history of the market, right? I mean, we get optimistic and then we get too optimistic and then we get a correction from there. So I may tell you fair market value is a value, but, you know, we could be 10, 15% above it before we get there at the end. But I think fair market value does give us another 5%, 6% this year, but we may go up 10, 12 before, you know, we sell off a bit. Fourth quarter, I think some of the guidance might be challenged as we're going to get in the next 2 weeks. Second half, I think we're going to meet second quarter, but second half, I think, might be a little bit more cautious than some people are anticipating.
What about the notion that earnings get a pass because of Powell?
Well, low interest rates are great. I mean, that does mean higher PEs. I mean, I often said that I think 18 to 20 is maybe the new normal, not 15 anymore, which is, you know, 19th century, early 20th century. I mean, when you have interest rates near zero and so low, I mean, that should mean a higher capitalization rate, both from the theory and in empirical work. So, you know, 18 to 20 is if that's the new normal, 19 is where we are now on a conservative basis. We're not overvalued.
Professor, it's Jim Lebenthal. I was a student of yours 22 years ago, and there's a few things that you taught me, one of which
One of you is aged better, by the way, and it's not the guy.
Hang on, Stevie.
Wow.
We got a whole show to go here, pal. Professor, one of the things that you taught me is thinking about big secular trends of where buying in financial assets is going to come from. An example of which was back then you were saying, look for the middle income class in emerging markets to start buying stocks. In that context, thinking about what we hear a lot about today, modern monetary theory, which is basically we're going to run the printing presses, and what you're talking about with low interest rates, which we all see as well. Is that possibly what gives this expansion and this bull market its next big leg? Is the idea that the government is going to spend because deficits don't matter, interest rates don't matter, and that spending will cycle through an economic expansion and a continued bull market?
Well, you you always have to be cautious. Say deficits don't matter. But the truth is, the reality is, there's an insatiable appetite for treasuries around the world. We're pumping out a trillion treasuries every year through our deficit, and they get snatched up right away. I mean, actually, U.S. treasuries are the go-to hedge asset. Against financial risk and everything else. So, if the Dow is down 1,000 points, treasuries are up 3. People like that. And that's going to keep those interest rates low on those treasuries. It doesn't mean we can run unlimited deficits all down the road, but it means there's an enormous appetite right now that I don't see waning. So I think you're right. I think we're going to be in a low interest rate world for many years to come.
Wow. So you say 5 to 6% more maybe this year. You could get a combined 10 to 12% more overall, I think is what you said. Can you get that with the so-called defensive sectors that have been doing quite well, continuing to do so? Or you need to have money coming out of those areas, the bond proxies and other things, you know which kind of sectors I'm talking about, and then going into more cyclical areas of the market?
Well, with this lower interest rates, we might see a return to more value stocks, more dividend-paying stocks. People are hungry for yield. You want to keep on squeezing into these high-yield, potentially risky investments when there's a lot of dividend-paying stocks that are paying 3-4%. with growth and potential, inflation hedges built in. I think that rotation, people say, yeah, I need that income. I don't want to stretch in the fixed income model. I'd rather get for the dividends on the stocks. A lot of those are defensive issues, what we call the traditional values. So we haven't seen that rotation yet. I'm sort of surprised once the pivot occurred, Powell's pivot in December. I thought we might begin to see it, but the second half of this year, really, we might begin to see that flow.